Hi Rohit, great speaking with you. Firstly, help us with your take on the benchmark indices because for today as well, from the word go, we are just trending lower. Though just yesterday we did see a dead cat bounce rather, but today once again selling pressure continuing. Where do you see the benchmarks headed, and can we support? Can we actually take a support of that 23,500 mark, or maybe the benchmarks are in to break that?
Yeah, good morning. And I think the setup is not very good. The peak that we made in October is probably here to stay for the rest of the year. And every bounce, therefore, ends up being counter trend. So the rally that we saw in November into December sort of retraced 50% of that. Now, from there, we are in the next phase of the decline. And I don't think it's over. We are probably headed towards 22,800 to maybe 22,200 as a worst case, and this should probably happen in the next couple of weeks. That's what I see. Probably the next major level at where we may get any meaningful support, maybe only sometime later in Feb or sometime early in March, I think is what the setup is really telling us. So till then, probably you're going to see lower lows, lower highs, small bounces and retracements along the way for sure. But that is going to be the trend. So even if I look at Bank Nifty, there's a very interesting technical pattern that people talk about known as the head and shoulders pattern. That's slightly more longer term. It's developed since I think May to June of this year. And the neckline of that is what we are breaking today. So that was at around 49,800. So if we actually close below 49,800, it would end up indicating that we are probably going back to 47,100 to maybe 46,200 kind of range in the coming weeks. So that is the setup in the main two indices that we are seeing.
Right. Actually, my question, Rohit, hi, this is Ankita also joining in. My question was a Nifty Bank. In fact, Nifty Bank is at its 6-month low. And like you mentioned that, the levels that we need to watch out for, and below that, is the banking space likely to be under more pressure because it has been underperforming?
It looks like because banks they go both ways. In a strong economy they can do exceedingly well, and in a weak economy they can actually do poorly as well. Even though that was the one place that funds were thinking of hiding because of the low valuations, but a slowdown in the economy does lead to a slowdown in the banking sector, and therefore low valuations remain low. So that is the risk that banks face right now. What that can only do is maybe limit the size of the decline eventually compared to what the mid caps or small caps might do, because that is where I think the maximum damage is happening now, finally, after months of people talking about it, and is likely to be the case also on a 6 to 12-month basis. So I think in that sense, banks may look prettier, but I think, again, I wouldn't buy them here. We'd probably, look at only some defensive sector, which is not going to be banking.
All right, but which are the defensive sectors, Rohit, you are talking about? Because just some of these sectors that are still trying to find some ground there, be it from the likes of the pharma names, some of these auto counters are doing well, and even the chemicals and fertilizer space is trying to hold some ground. So, any of these sectors that you like at this point in time?
I think it's only healthcare that has been holding out throughout this time period. It has actually done well since November, better than the market. And that might only end up being the saving grace. I mean, may not be for today. I mean, today can be an exception because everything is selling off. But like I said, over a period, it has shown some performance. So if funds have to go somewhere, they're going into pharma. They used to historically even go into FMCG, but that sector is still showing weakness, though on a slightly more medium term basis. I think it's possible that most of the selling in FMCG is done. So I'm just looking at the FMCG index. It has made two bottoms near 55,380. It's possible we go there a third time and maybe don't break it, and that would be a good thing. So we need to watch if in this sell-off 55,380 holds for the FMCG index. Possibly that could be a near-term 3-month, 4-month period. I would say could be a defensive area that could work out.
Rohit, I'll take a leaf from what you just said about the FMCG space. Have we really bottomed out, and now do you see a reversal on the cards? That's one. And secondly, the other sector that has really held out well is the IT sector, that has also managed to hold out, when the markets, fell, from those highs of, a 10%, downtick that came in on the Nifty. Nifty IT held out pretty well. In fact, Nifty IT is up in the last 1 year. It's up 25 odd percent. Do you see that sort of a move coming in on IT as well?
So first, let me clarify on FMCG that it's not a long-term bottom, but a medium-term one, more on a trade basis. And the level I mentioned, if it holds in this sell-off, then we would look at upside there, and then it would probably fall less because it's already fallen. The IT index doesn't come in the same zone because the IT index is just starting to roll over into a sell-off, and it tends to follow the US markets more than anything else. So if you actually look at the NASDAQ, it was outperforming and holding out till the early part of January. And that is possibly why you also saw the Indian tech sector do pretty well. But that is now beginning to weaken. You're seeing weakness in both the S&P and NASDAQ, which are the stronger parts of the market, and the weaker parts were the industrials and secondaries. So now that you're seeing weakness in tech, I don't think it's time to look at it as a defensive. In fact, we should be worried. We should be a little careful. I think you can get lower levels in tech stocks along with global markets, and therefore wait. It may not work as a defensive. So the only defense might be, like I said, slightly longer term pharma, slightly medium term FMCG, but not the IT sector.
All right, Rohit, with this, we'll let you go on that.
If you like this video, then like, share and subscribe to ET Now.